In order to do some of the financial feasibility and estimating, we need to be able to kind of think about, how does this potential business compare with itself year over year, for example, or how does it compare with industry itself versus other businesses of the same? Some way to be able to say that this one measure up, this business idea potentially measure up to something that already exists. Again, looking at that issue of this, is it worth doing? So we've got this issue of financial ratios, and I believe in first year accounting that you have covered elements of financial ratio analysis. Now, this doesn't go into it all that deep, but effectively what I want to just reinforce to you is that if we can kind of think about, do we have enough oomph in this business in order to make it work? Okay, so the financial ratios help to determine the amount of oomph. And I got a bunch of examples here, okay? Basic financial ratios would really be used, for example, to assess the quality of the business. And we think about how much debt to asset, how much money are we putting into the business out of our own money? How much are we going to borrow? That's what we really mean by debt to asset, okay? How much are other people going to lend? How much are we going to put in? And one of the things that you can do is go, and there is information online. I haven't sourced it here, but there is information from Stats Canada and the like that says, generally, for your type of business, whatever your type of business is, the debt to asset ratio, the standard is whatever, 3 to 1, 2 to 1, 1 to 1. And you're going to say, do I meet that standard? Do I anticipate, for example, if I'm going to put $1 million, I'm going to hope to get $4 million from investors, total of $5 million. Really, you are 20% is your debt to asset ratio on that. Your 20 cents of every dollar is your own. Is that matching what is normal for the industry for that type of business? If it is, that's a good sign. If it's not, meaning that you are relying too heavily on borrowed funds, or meaning that you're putting in too much of your own money, you can probably do a little bit of reassessment of whether that was a good idea or not. So this is probably the one that would certainly be most important to business, to banks and the like. They want to know, okay, look, how much are you asking for, and how much are you putting in? Because if you don't have any skin in the game, if you're only putting in 20-cent dollars, for example, the business goes belly up, who's the one's going to lose out of that? The bank, because they own 80-cent dollars. So they're going to be looking for as much investment from you as possible. We also have a very similar ratio called the debt to equity ratio, okay? And again, we're saying, okay, how much did you put in versus how much is someone else putting in? And what we're doing there is taking our total liabilities and dividing it by shareholders' equity in order to really get a sense of how much are the owners contributing to this, how much skin do they have in the game. And it's, again, an important measure to be able to think about the risk being shifted to the borrower, to the lenders. We also have another type of ratio called liquidity ratios. Now, these liquidity ratios really come into play when the business is actually up and operating. But they measure the amount of cash and the ability for a business to pay its bills. That's effectively what you're doing. So if we think about the first one that is often used, is trying to come up with an idea of what's called the current ratio, or sometimes called the working capital ratio. It looks at how much money do we have on hand versus how much money do we have that go out. And what we're doing is saying, can we pay our bills effectively? So we're looking at our current assets divided by our current liabilities. Now, our current assets, if you look at a balance sheet, for example, you'll see current assets are all the assets that can normally be converted into cash in the first year or within 1 year. So things like inventory, cash, accounts receivable, these sorts of things would certainly be current assets. Current liabilities are liabilities that are going to come up for payment within 1 year. Accounts payable, these sorts of things, some degree of notes payable. And the ask is, Do you have enough money in your cash or near cash reserves to pay those bills? If you do, that's a good sign. If you don't, then that spells trouble for the business, because someone's going to have to pony in some extra money in order to pay those bills. A little bit of a stricter one that banks often use is something called the quick analysis. And the quick analysis really says, okay, look, it's current assets over current liabilities, same thing. But the fact is, current assets include inventory. And I remember I had a really good example of this, because I remember when I did this course, my first accounting course in 1984, holy moly, in 1984, the lady that taught us was an accountant who was doing audits. Oh, fun stuff. And she was telling us about B&K carpet. And years ago, if for those of us old enough, remember Tony Baldwin from B&K Carpets. He used to be on TV all the time selling carpet. And they had done a assessment of B&K Carpet. And they'd gone up and looked at their inventory of carpet. Now, carpet, as you're well aware, is fairly expensive. So it would be inventory, and it would be considered a current asset, and it would obviously bring up their current assets, and their current ratio would be healthier, in the fact that they had lots of carpet in the inventory. The question is they had several rolls of carpet in their warehouse that were the ugliest, ungodliest color that you could possibly imagine. And was that carpet really saleable? Was anyone ever going to buy that carpet? And when the accountants looked at it, they said, probably not. And because it was not saleable, that means that really it wasn't a current asset anymore. Even though it was inventory, and inventory is normally considered a current asset, the fact is that some of that was probably unsaleable. So the quick ratio takes inventory and throws it out, and any other current asset that may not be as current as what you would like. So effectively, it gives you a tighter measure of, can the business pay its bills? So banks look at this one probably more often than the current ratio, because the current ratio includes those assets that theoretically are turned into cash within 1 year. But this one here, the quick, says, they might not ever be able to change the cash. Let's just wipe them out. And we're looking for a little bit of a tighter measure of, can they pay their bills? We also want to think about profitability. And again, primarily focused for a business that's up and running. When we look at profitability and we say, well, how much profit does the business make? So we look at profit after taxes versus its net sales. And this is really a good indicator of how much money per dollar sold does the business get? How much extra, how much value are they putting into something? In other words, the profitability of the business. And we need to be able to look at net profit after taxes really as a good indicator of, does the business have the ability to turn some dollars? And we also look at income from operations over total assets. How efficient is the assets being used to generate those dollars? If you've got billions of dollars worth of assets, yet has earned no real income, that's not a very efficient use of your assets, is it? That's like having money in the bank that's not earning any interest. Your assets need to be able to generate profit, generate money for you, and we're going to be looking for as high a possible relationship there as is possible. We're also looking at this issue of saying shareholders' equity. How much value do shareholders get out of this? And we're looking at taking, okay, how much income comes in, less taxes, less interest. That is income that is owned by that the shareholders can look at. How much income is being generated for the amount of money that people have invested in the business? It's equivalent to the interest rate. Okay, you think about, you got $1 million investment, invest it. Let's say shareholders' equity is $1 million, and your net income after taxes and interest and all that sort of stuff is $100,000. That's the equivalent of $100,000 interest, or about 10% interest. So you're saying that that's turning about a 10% rate of return. Now, if you can put money in the bank and get 10% with no risk, and you're getting only 10% here with all kinds of risk, it's probably not a very good investment. So you need to be able to earn a return that is relatively high relative to the bank rate, or what you can get in a bank operation, because in order to legitimize the business being worth the risk, you need to earn a higher rate of return. We also have some what we call benchmarking tools. And as I said to you, there are normal amounts that you would find for most businesses of a certain type. For example, their normal current assets, or their normal quick assets, or their normal interest before earning and taxes, these sorts of things. And what we can do is use these as benchmarks, meaning will our proposed business make those same percentages? Will it be proportionally the same? If it is, that's a good sign. If it's not, that's not such a good sign. The example could be, for example, average collection period. Okay, how long does it take for the bills to be paid? How long does it take you to get money come into the business? And you say, well, if the industry is 45 days and you're taking longer than 45 days, that's not a good sign. If the industry is 30 days and you're taking 10 days, that's a good sign. You're getting your money in much easier. Or we could look at the average day payable, which is how long does it take you to pay your bills? Are you behind on your payments? If you're behind on your payments, it means you're probably paying interest, or you're not getting the best value in terms of paying your bills on time. So as a result, you're paying higher prices. And we also think about how well is your inventory turning over. If you got inventory sitting on the shelves and is there gathering dust, that's not very useful. You need inventory to come off the shelves and get replaced on a fairly regular basis. So one of the measures that we have is this inventory turnover, which is kind of like thinking about your shelves emptying out X number of times a year if you didn't replace it. So you know your total amount of inventory, and really what you're saying is your cost of goods sold, really divide it by the average inventory that you would have, and that'll tell you how many times really it flips over. The more often your inventory turns over, it's a good indication that you're getting good value out of your inventory. If your inventory is sitting on the shelf gathering dust, that's not such a good time. So it avoids aimless searching. The table of contents should include a list of major topics in the plan and their respective page numbers. Next, it's the most important part of the plan. The executive summary is what most people will read. They might not ever go past there, but that's the thing that most people are going to read. So it has to be well written and it has to be concise, because what the executive summary is, it is a summary of everything that comes after it. So effectively, if the document is 35 pages long, it summarizes the 35 pages into 1 or 2 pages. So someone can read it very, very quickly. So it is really the sales pitch that we're dealing with here in the assignment 1. The sales pitch is really caught up in that executive summary. So the executive summary is a short overview of the entire business plan. It provides a busy reader with everything he or she needs to know about the new venture's distinct nature. Along with the executive summary appears, although the executive summary appears at the beginning of the document, it is normally prepared last. So after you've done your business plan, then you write the executive summary and you insert it into the front end. Not all business plans have a mission statement, but all business plans have a basic paragraph that says this is what this business does and this is who it does it to. And this is what the mission vision statement section is really all about. It is a effective, quick and dirty, quick, simple, here's what we do, here's who we do it to. The best effective way to introduce the business to is to describe the opportunity to the entrepreneur that is identified, that is the problem to be solved or what needs to be filled. Then describe how the business plans to address that issue. So it's really a vision for what the company is going to look like as it moves forward. So for example, in the case of Little Bites, it's going to be the leading alternative and traditional fast food restaurant offering healthy and flavorful meals in a quick service format. Okay. Once you've done the kind of a, here's what we're about, you're going to give a little bit of a brief history. Now, if your business is brand new, you say, well, it doesn't have any history. True, that's true. But where did the idea come from? How did you get to where you are right now, effectively? So an existing business, you need to write the history. For a new business, you just want to say, where did the basic idea come from? So in this particular case, Little Bites Grill is an incorporated business that plans to develop a chain of corporate-owned restaurants, caring for busy, health-conscious professionals and vegetarians. Presently, the fast food outlets are underservicing the rapidly growing market segments with very limited product offerings. The LBG version, Little Bites vision, is to exploit the opportunity by developing a premium quick service menu offering a wide variety of items. So this is kind of like laying out the background of what the business is. Next, we look out into the world and we say, okay, what is the industry analysis? What is the industry that this business is operating in? How is that industry going to either help or hinder this business grow? So this section should begin with a discussion of major trends in the industry in which the firm intends to compete, along with important characteristics of the industry, such as its size, attractiveness, profit potential. There's an industry feasibility analysis that is being done. So this is actually your next assignment, to look at the feasibility analysis. And after reading the industry analysis, investors should have a good grasp of the future prospects for this industry, let alone this business within the industry, but this industry, along with an understanding of the target market that the firm hopes to pursue. This section should also outline the basic goals and objectives for the business. The business analysis should provide measurable outcomes. This is where we get into SMART goals, specific, measurable, attainable, realistic, and time-bound. So we're looking at when is it going to happen, who's going to make it happen, and the how it's going to happen. The next major component that we need to look at is the concept and strategy. So when we looked at the previous one, it was really focusing on the industry, which is the external world. This one really looks at the business itself. So we're looking inward now. We're saying, okay, how can our business set itself up to take advantage of the opportunity discovered out there in the outside world? So the business strategy will outline how the goals and objectives will be achieved. It will attempt to explain how the business will successfully compete in its chosen market and against its competitors. Reviewers, this section, will be looking for how the company plans to attain competitive advantage. How you can do it better than anyone else. Sell the reader on how the business will look unique in the eyes of the customer. So what makes it stand out? The marketing strategy is a time when you detail the reasons you believe there's a real market for your product. Outline the substantive things that you have. Back it up to say that I believe that this will meet the needs of this chosen target market. This is especially important to develop a clear understanding of the market size and the market trend. So the market strategies also include section details in which it details your pricing strategy. Where's your price coming from? How much you can charge? Your sales and distribution plan, and your advertising and promotion plan. So it looks at that, really those elements of the 4 Ps: the price, the place, the product, and the promotion. So that's an important section. Once we've got that taken care of, then we move off to a basic description of the product and service. What is it that you're actually selling? So this section follow the industry analysis and should provide detail of the firm's product and or service. The section of the business plan typically is carefully scrutinized. Someone's going to look at this really hard because, you said you got a competitive advantage. They want to check it to prove it. So it's very important to investors in particular to be confident that a new venture has a product that people will buy and has a realistic plan for getting it into their hands. The section should begin with a fuller description of the product, the firm that will sell it, and be provided that has been provided in the previous sections. The results of the feasibility analysis should be reported, including the results of the concept test. We're also going to be looking at, in terms of the description of the product or service, we're going to be looking at what is the market out there. How are you going to compete in this? How big is the market? What is the estimated sales? You start moving in some numbers here and say, okay, look, how can I legitimize this? Is it possible, if there is a market out there, that I can actually generate enough money to pay for the business and make money on it? So you need to worry about that. You're also going to be working on a competitive analysis. Who are your competitors? Where are they in the market? What are their advantages? What are their weaknesses? So it's vital importance to consider competition when developing business plans. It's essential that potential owners, investors, and other stakeholders appreciate that the business understands that their competitors are there and they need to be considered. This section of business has an opportunity to explain how and why it will be able to compete with its competitors. Next, one thing to say all that, then you got to say, well, who's going to make all that happen? So the management team includes the marketing team, I would imagine. The management team needs to be in congruence with the product. For example, if you say you're going to be making steel girders, let's assume that your business is going to be in the steel making business, yet the owners or the management team know nothing about steel making, that's not a good fit. That's not going to go over well. So you want to make sure that your management team has the necessary skills and abilities to move the product idea forward. So one of the most important things investors want to see in reviewing the viability of a new venture is the strength of the management team. The material in this section should include a brief summary of the qualifications of each of the key members and make sure that it lines up with the needs of the business, including how his or her relevant employment, professional experiences, significant accomplishment, and educational background would help facilitate business growth. It's also important to show the financial obligations of the management team in the venture. How much is it going to cost? So then you get down to the nitty-gritty in a business plan, which is really operations. And that is, how are you going to physically operate this business? It's much more detailed in terms of, this is how we cook hamburgers, that sort of thing, if you got a hamburger business. So it deals with the day-to-day operations of the business. So this is, the devil is always in the details, and this is really a detailed section. How are you going to make the business successful? So what form of ownership? What's the store going to look like? What's the building going to look like? If we got a production facility, what's the flow going to look like? These sorts of things need to be in there. And you can see here that they've talked about their location, their facilities, their equipment, their supply chain, human resources, which is people, their regulatory requirements, what's needed to be done, and their insurance plan, risk analysis. At the end of the business plan, or I'm going to say, the last major component is the financial analysis. And that's where you say, okay, 2 + 2 = 4, and 4 is enough. So you need to be able to prove here in terms of the numbers and your projected sales that you can actually make money with this business. So the financial section of the business plan must demonstrate financial valuability. Careful reader of the plan will scrutinize this section. Should include financial projections, which are intended to demonstrate the financial viability of the firm. Financial projections should include 3 to 5 years of pro forma income statements, and pro forma income statements is really projected income statements, projected balance sheets, and a statement of cash flows. We're going to get into the detail in this as we move a little bit further along. So you can see that these are normally put in as spreadsheets that demonstrate how the business is going to move ahead. Sometimes, too, we have what's called an investment proposal, which is a statement that we want $1 million, or we need 6 investors that can supply $1 million. So effectively, it is the explanation of the type of funding that's needed and who's going to provide it and how many investors you need. Really, it's the sources and uses of funds. Finally, all business plans have an appendix, which is like any surveys that were done or documents that are not pertinent to the actual detail, but how you got the detail. So any of the information that you collect using primary data sources such as a observation or a survey would have to get put into the appendix. So those tend to be the key components of all business plans. On this very last slide, I have a whole bunch of links there to business plans. There's lots of business plan models out there. I'd like you to take a look at some of them. You'll find that they're all of a similar format. And they all contain these essential ingredients, or most of them contain these essential ingredients, depending on the type of the business, that are referred to in this show. So you're going to have to take a look at that. And as we move forward, we'll be moving into that with regards to the assignments. You're going to see, for example, under content, assignments, this proposal that I have asked you to do, is coming up. But assignment 3 is the concept development of the business, which is really the business plan, and it's worth 15%. And it talks about, I've laid out here, effectively, here are parts of the business idea, that you want to put into this. And you'll see that these points that I've indicated here are really the components of the business plan that we just outlined. So you're going to be, in the next assignment, taking the concept and moving it forward into a proper business plan. Okay, any questions? Well, that's as far as I'm going to go today with this. Tomorrow, I will do a review. The class, I think, first thing tomorrow morning or somewhere around there. I'm going to be doing a review of what we covered. But that's as far as I'm going to go today. Okay? Questions? Nothing? No? No questions? Well, if there's no questions, if you do have some questions later on, send me an email. And otherwise, take a look at that business plan, the little Bites Cafe. I got it in there in a PDF. You can download it. And otherwise, we'll see you in the morning. Okay? See you later.
Thanks. Take care.